Hey, welcome to this special episode of the Women in Money Cafe. So today, right, we did an episode on pensions a couple of weeks back, and the feedback we've had from that is really good. And it was always the intention that we would make this a series, and we wanted to do an episode just specifically on tax relief. And I think this is important because it's one of those phrases that gets thrown around about pensions a lot is, oh, well, we put into your pension, you'll get tax relief. And it's like, we use that phrase a lot, but do we ever properly explain what it means? And it's a really important phrase because it's the whole reason that makes pensions so goddamn attractive. So by the end of this episode, you are going to know exactly how pension tax relief works for your specific circumstances and why it's such a cool idea. Now, thankfully today, Catherine and I are joined by the resident pension guru, Michelle.
Yay.
So good morning, Michelle.
Morning, Michelle.
Good morning to you both. Lovely to be here.
All right, I've done the good morning thing, Catherine.
Very good, very good. Hello to everyone who's listening later in the day.
Yes. So good evening and good afternoon. And can we just, you can't see this, folks, you will eventually, right? But Catherine's just pointed to me to show that she's got her Women in Money Cafe mug, right? So we've synchronized mugs because Catherine has been turning up to record with the wrong mug. So that she's got it today, I think is a really good sign. It's going to be a cracking episode. Okay,
Michelle's looking desperately around for hers, thinking, I forgot my mug.
Mine's in the kitchen.
She regularly turns up with her mug, so we're okay. Right, so I think probably, Michelle, you'd be the best person to get us started on this and just sort of giving us a broad overview of tax relief when it comes to pensions.
So yeah, it's a question we're asked a lot, as you know, as you said, and I think the easiest way to explain it is that when you save into a pension, the government gives you a bonus to reward you because you're saving for your future. And I think that's the way to sort of look at it. And you receive tax relief on any pension contribution you make, so any money you pay into your pension at the same rate that you pay income tax. So for a basic rate taxpayer, you'll get 20% tax relief. For a higher rate taxpayer, you'll get 40% tax relief. And for an additional rate taxpayer, you'll get 45% tax relief.
Okay, thank you for that.
I was going to say, that feels like that. Thanks, Michelle, you've explained it all. End of episode. That was a really clear way of putting it, that we put a contribution into the pension and the government puts the rate we would have paid tax on that in. So
all right, so but do you know where my head's gone? It's like, you know, you get those chocolates or sweets sometimes that come in wrappers, and there's sometimes two wrappers, isn't there? There's like the cellophane colourful bit and then a silver one underneath. Do you know what I mean?
yeah, like the toffee pennies. Yeah.
So the toffee pennies. So the cellophane bit is maybe the pension wrapper, and then the silvery, the goldy bit, is that the tax relief, Michelle?
It is, because it's your free money. It's your glittery bit on top.
Right. If this is making no sense to you, you need to go back and listen to Pensions 101, where Michelle does a cracking job of explaining pensions in terms of Quality Street.
Yay. Episode 14 for anyone who is looking for it.
All right, awesome. So I think one of the things we want to do then over the next 20 minutes or so is just explain to you how it works depending on your specific circumstances. So it might be that you are a non-taxpayer. So should we start there actually with the non-taxpayers? So who would like to have a go at this one?
So if you were a non-taxpayer, you would be, you know, I've had clients say to me, well, that means I can't claim any tax relief, but that isn't correct. So the government is still trying to encourage people to save for their retirement because it's in their benefits to do so. So as a non-taxpayer or non-earner, you can put in, so if you're non-earner, no salary, you can put £3,600 into your pension a year. But that includes your tax relief. So actually only costs you £2,880 to have £3,600 appear in your pension. So that's something quite a lot of people don't know. And it just allows those that other circumstances who may not be working, maybe parents, carers, who can then put that money into their pension.
Okay, and let's just clarify here what a non-taxpayer is.
So yeah, that's to be somebody who is earning less than 12,570 or who isn't working and has no relevant earnings for tax.
Yeah, so if your earnings are under that amount, you don't actually pay any tax on your income.
No.
If you put some of that money into a pension, even though you've not paid tax, you're still going to get the tax relief, which is wonderful.
It is. I found that out by accident when I was a stay-at-home mum. I just assumed as I wasn't working that I couldn't make a pension contribution. But as you've just said there, Michelle, even if we've got no earnings whatsoever, we can put the 2,880 in, which gets topped up to 3,600. And then when we're low earning, so if you're earning 10,000, you can put up to 10,000 in and still get the tax relief.
And also it's the side of it that you can also put in money into a pension for your children. So you can still put 3,600 in for your children. They receive the tax relief. So again, it still only costs 2,880.
Fantastic. All right, have we got anything else to say about non-taxpayers and how tax relief works for them?
No, I think that sort of sums that up for them, doesn't it, Catherine?
I think so. I think the only thing would be that if you feel that is you, then don't be put off. If you've got children or yourself, then go and open a pension if that might work for you. I think maybe just to clarify, because this is where I struggled, is if you've got no earnings, you're capped by that limit that Michelle's just said, which is the 3,600, regardless of whether you earn 3,600 or not. But otherwise, excuse me, you're going to be capped to 100% of your earnings, up to a limit that we'll cover later. But for the non-taxpayers, you could effectively put the whole lot into your pension.
All right, fantastic. Okay, so moving on then. If you earn more than 12,570, yeah, if you earn more than that, then you've tipped into becoming a taxpayer. And the first bit that you dip into is becoming a basic rate taxpayer. Now, for the purposes of making it easy, we're going to use English tax rates, but for all our Scottish listeners, the principles are the same. It's just we have 101 different tax bands up here. And it'll be a much longer episode if we do the 19, 20, and 21 and all the other tax rate bands. So after the 12,570, once you start earning above that, you become a basic rate taxpayer. So could somebody explain to me how pension tax relief works for basic rate taxpayers? When I say somebody, obviously I mean Michelle.
So for a basic rate taxpayer, depending on how your tax relief is paid to you, and we'll cover that in more detail later, you will automatically receive basic rate tax relief. So you're 20%. So if you were to want to contribute £100 to your pension, you pay in 80, and the pension scheme will then receive tax relief of £20 to make it £100 in total. So that is automatic. As Julie's coming round to, when you are higher and additional rate taxpayers, it isn't quite as straightforward.
All right, so let me just check my understanding here. So I am a basic rate taxpayer. So let's say I've got a salary of about £20,000, because that firmly puts me in the basic rate tax band. Basic rate tax is a tax, so that income between the 12,570 up to my £20,000 salary is taxed at 20%. So I want to put some money into my pension. So I set up a direct debit, and it's £80 that goes into the pension each month. And what you're saying, Michelle, is those lovely people at the revenue are also going to send money to my pension each month, and they're going to send £20. Is that right?
They are, yes.
So I've just bought £100 worth of pension savings for £80.
Yeah, and you didn't even have to do anything. It was automatically applied for you.
Oh, that's really cool. So I don't have to do any work at all.
Not for the basic rate, and I'll cover why for the high rate afterwards, but super, super easy. Nothing else to think about, just put the money in.
For most pensions, that would be called relief at source, which means you're paying it in and they claim the tax relief. The pension provider claims the tax relief on your behalf. So again, as you were saying, you have to do nothing, but that's relief at source. So if you hear that word, that's what it means.
All right, so all you basic rate taxpayers who are employed, relief at source, you're going to put £80 in and £20 from the revenue bump you up to 100. Whoa, nice.
Very nice.
Okay, where are we going next, ladies?
I'd like Michelle to maybe delve a little deeper into the other option, because she kind of alluded by defining relief at source that there might be a different way.
So there is. So the other way, which many workplace pensions, so if you've been enrolled into one through your employment, they will do something called a net pay arrangement. So with this, the pension contributions are taken from your salary before you pay income tax on that salary, on that portion of your salary. So you do not pay income tax on the amount contributed. But what that means is you don't pay the income tax, but you've automatically got your tax relief because you haven't paid the income tax. The full amount has gone into the pension. And so you, for this one, would get full tax relief at any of your income tax rates. So if you're a higher rate or additional rate, it's automatically within your pension. So I think the best way of putting it is if you did your pension tax relief at source, so the relief at source, you pay in 80, it appears to be £100 in the pension. With the net pay, you are paying £100 in, £100 goes into the pension, but you haven't paid tax on that money. So you've had your tax relief.
So I would get my tax relief in that scenario the month that I'm paid effectively, because I put 100 into my pension. Therefore, there's less on my pay slip to pay tax on.
Yes.
And that's how I feel my relief, by having more in my bank account today.
Yes.
All right. So the net pay one, I get paid my salary and the revenue of taking 20% of it in tax. But any part of that salary I put back into a pension, they give me the 20% back. With the net pay arrangement, the money goes into the pension before they've not stolen, didn't say that, the revenue, before they've taken the 20% tax. So there's none of this having to rejig the money around so that we're back in the same position. Is one better than the other, Michelle?
I think they both achieve the same outcome. The net pay does allow those who are higher rate taxpayer to not have so much sort of, I suppose, faff afterwards to try and claim their extra bit of tax relief. The one downside with net pay is if you do earn, say, £10,000, so you're not a taxpayer because you're below the 12,570, you don't receive a benefit as such because you wouldn't pay tax on that income anyway. But the government are making changes from 2024 to allow them to receive additional benefit for that. So it is coming, they're catching up, but they're not quite there yet. So if you do earn below the 12,570, it's not as attractive.
All right. Okay, thank you for that, ladies. So I think we've covered off how tax relief works if you're a non-taxpayer, and we've covered off how it affects basic rate taxpayers. Anything else to add to basic rate taxpayers?
Can I just say that whilst we are saying it's free money, and it is for the whole lifetime that we're saving into the pensions, it is almost to balance out that at the other end, when we take our pension, we will be taxed on that as though it's income. So in that respect, it's quite tax neutral. So you get the relief on the way in because you're paying it on the way out. But the bit in the middle is you get all of those years for your pension savings to invest on the larger amount. So you're still better off.
Yes, definitely. And I think the government the relief is all about trying to encourage you to save. So if they can give you a bit of a tax break now, even though you will pay it later, as you say, it's making it more favourable.
Okay, awesome. All right, so then once you start earning over a certain amount, I'm not going to give the figures because it varies from country to country, all right, you then tip into the higher rate tax band. So for everybody that's listening, I want you to picture a bucket. Yeah, I'm here with my buckets, right? So we've poured in £12,570 worth of income into your bucket. And that first bit is tax-free, there's zero tax on it. Then we're going to chuck in some more, and that gets taxed at 20% or 19 or 20 or 21. And now we're going to fill up the bucket even more. And once it gets past a certain threshold, then you have to pay 40% tax on that bit up above the basic rate bit. So pension tax relief works a little bit different for higher rate taxpayers. So Michelle, would you sort of give us an overview of that, please?
On the higher rate taxpayer receiving that tax relief.
So just how it works for higher rate taxpayers, please.
So they will have received their basic rate tax relief already. But in terms of the higher rate tax, you are entitled to your extra for a higher rate taxpayer, 20%, if we go on the tax rate for 40%. But that has to be reclaimed via a self-assessment tax return with HMRC each year. So you will get it back, but it will be delayed. But then you do get a sort of check at the end of it to do as you wish.
Okay, so let me check my understanding then. So if I'm a higher rate taxpayer and I put money into a pension, it's going to attract that 20% basic rate tax relief straight away. But because higher rate tax is 40%, I've had relief at 20%, so I'm due another 20% from somewhere.
Yes. And so in the end, if we go back to our £100 example, you have £100 in your pension, but for a higher rate taxpayer, that's only cost you £60 because you've had £20 back when you first went into the pension, and you can claim your extra £20 back via your self-assessment tax return.
All right, let's talk about how we get this other £20 or 20% back then. How do we do that?
I think we've got two ways of doing it. So Michelle said there, we can claim it back if you do a self-assessment. And the other way is you can simply write to HMRC with a list of your contributions for up to 4 years and tell them this is what I've paid in, and they will just send you the money.
All right, so what we mean here, folks, is if you're a higher rate taxpayer, all right, so you're putting your money in your pension, you're getting the basic rate relief getting sent into the pension by the revenue. And then those lovely people who I did not accuse of stealing your money, they actually send you a check for the rest.
They do. And you're in. So if you know you are a high rate taxpayer and that's something you've not been doing, we can pop a note in the show notes, but you can just write a letter and you just put your annual contributions for the past 4 years, and then they'll get the 20% back on those annual contributions as a check.
I actually have a template for that letter.
Even better.
I will make it available in the show notes for anybody. If you high rate taxpayers who think they might not have claimed the extra 20%, check out the show notes for a templated letter to send off to the revenue.
Yeah. I think that, to me, that is probably the one thing I would say if you can take away from this episode, because there's so many people I find that don't know about that, and there's another 20% of everything you've put into a pension for the past 4 years that you can just claim back and do whatever you want with that. So to me, that is a real key takeaway. So do check out that template.
All right, so am I right in thinking that was the relief at source method we were discussing?
Yes.
Is there an alternative?
For the
higher rate taxpayers, is that the only way they get their hands on the additional tax relief?
The other one would be their self-assessment. They can do the same claim, but do it on an annual basis. So if you know about it and you're doing it, there's a part on your self-assessment when you're completing that where you put your contribution in, and it can be factored in as part of that.
That's where I was going with this. I think, because correct me if I'm wrong, am I right in thinking you can ask the revenue just to adjust your tax code?
That I don't know. I think with the self-assessment, it's done as part and parcel of the big picture, isn't it? So my preference is I do like a letter and a check. But that's because I also don't like the self-assessment form, even though they have tried to simplify it. But yeah, there are those two options. So if you've got an accountant and you're regularly doing that anyway, then that's probably the most natural way to do it. But if you're not filling self-assessment in because you're employed, for example, and you want to claim it back, then maybe the letter is the least faffy way for you.
The letter seems easier, doesn't it? It seems easier and nicer to just have a simple check back in the post after that letter's gone.
Yeah, nobody wants to volunteer for self-assessment, do they?
No. I think if you're already doing it, so maybe if you are kind of self-employed making your contributions, I may have gone wobbly there. No, we're fine. I'm back with it. Catherine's had a sip of coffee and caught up again. Then yeah, it's probably worth doing it if you're already doing it. But why would you volunteer just for the pension contribution when a simple letter would do?
Okay. Anything else on higher rate taxpayers then?
I think maybe just to nod to the earlier is that you're getting your higher rate pension tax relief on the contribution you're putting in today. When you take that out as an older person, so any time that you can take your pension, which is currently 55 plus, If you're a basic rate or nil rate taxpayer, you'll be paying that rate at the time that you take it. So just because you've paid higher rate today and had the higher rate tax relief, if you're a different tax rate on the way out, then you'll pay a different rate as you come out. So to me, that seems even more beneficial, that you'll get more in the early years, even if you're going to be paying less on it later.
All right, let me see if I can butcher this. Okay, I am a higher rate taxpayer and I want £100 in my pension. So I receive, of the £100 income I receive, because I'm a higher rate taxpayer, the revenue have taken 40% of that off me. So £100 that my employer pays me gets turned into £60 by the time it hits my pocket because of tax.
Yeah.
But if I go and put £80 into a pension, then the revenue will throw in £20. And then the next year, once I've written them a nice letter, because we're pen pals, they will send me a check for £20.
Yes. Yeah. And somebody may have noticed that it's actually the other way around, isn't it? So the tax, it's worked backwards. So from your £100, you've only had to contribute 60 and you got, 80, and then you got 20 back, which is actually the equivalent of 66%. So if £60 goes in, you're not getting relief of 40% on the £60, are you? You're getting the relief on the £100. So it's actually even more. Did that make sense? I may have butchered that.
I don't know, I was just doing the mechanics of £100 with my employer arrives to me as £60. I want £100 in my pension, so I sent £80 into my pension, the revenue chuck in £20, and then a year later they send me a check for £20. So I'm back up to £100. And then the point you were making, Catherine, is when I retire, I might not be a high rate taxpayer, and when I'm taking income from the pension, I might get £80 back out.
Yes.
Yes.
Or who knows? All right. Right, are we good on this?
Simple. It is simple. So make a pension contribution. If it's relief at source, you get the 20% put in, and then you claim back the extra 20%. So yeah.
Okay, so then still in the high rate taxpayer. So we've covered that relief at source. How does net pay work for higher rate taxpayers?
So with net pay, you're receiving that tax relief immediately because you haven't paid tax on that money that's gone into the pension. So if you want that £100 to go in, the £100 you come at pay out of the salary before tax, but it does mean you've just saved yourself £40 in tax because you haven't been taxed on it that month. Does that make sense?
And no faff, no paperwork.
No.
Can I ask, if I was a higher rate taxpayer, how would I know which one of those I was? Would I know if I was, what would I look at to know if I'm doing it via my employer or whether the provider is taking it at source?
So I think the biggest clue is when you get your pension statement is have a look and you'll see. So we'll have what you call your net pension contribution and then your gross. But if you're getting relief at source, what you'll see is your £80 coming in, and then you'll see HMRC tax relief as a separate sort of transaction entry going in of your £20. But if you have net pay, you'll just see the £100 going in. So it won't be broken down into the two amounts.
Okay. So if monthly I can see one single payment going in, then my boss is sorting it out for me. And if I can see two, a smaller amount and a big amount, then it's at source and the provider is getting the extra piece.
Yes.
Okay, and I think the key takeaway for me there is if it's this net pay arrangement, if I'm a higher rate taxpayer, woohoo, I don't have to do any paperwork. If it's not, then I need to do a little bit of paperwork to get my extra money back.
Yeah,
yes.
But it is that simple template letter sent off to HMRC, so it's not a huge faff.
All right, fantastic. Hopefully people, listeners, I hope that you're getting why we get excited about the tax relief, okay? There's all these 20 and 40 pounds sloshing around out there that are yours. And we're just trying to explain to you how it works, how you get it, and make sure you're getting everything you're entitled to. Okay, so we've covered off non-taxpayers, basic rate taxpayers, and high rate taxpayers. We didn't have it on the agenda to do additional rate taxpayers, but if at some point you want us to cover that, then do drop us a message and we will do it. Okay, but I'm guessing it's not relevant to most of the people that are listening to this.
And I think it's very similar to the higher rate, isn't it? But just with a bigger number.
Yeah.
So an additional 5% again if you're in the UK, but same process as higher rate.
All right. What else have we got to cover then, ladies?
I was just playing with my calculator, so I'll
Oh
come back
dear
to you.
God, it's either a calculator or a spreadsheet. Right, what have you got for us, Catherine?
I haven't yet. Because I think that sometimes we make a mistake, because my little head it doesn't sound much, does it, when it's a £60 or £100? But if you're a higher rate taxpayer, in order to be a higher rate taxpayer in the UK, you have to be earning in excess of, I forget the exact number, but over 50,000. And if we're putting minimum contributions into our payment, into our pension, which is 8%, these are actually much bigger numbers. So whilst you guys talk amongst yourselves, and I just pour myself another coffee in my mug, I was just going to work out actually what that is that you would be getting back.
Well, as we segue then, while Catherine gets a pen and pencil and abacus out. One of the things that was popping into my head from when I was an employee and I was a higher rate taxpayer. So sometimes if we'd been good, we would earn bonuses. Woo! And the way I always used to think of it, because I was a higher rate taxpayer, if I was getting a bonus of £5,000, I know really in real life it's only 2.5, because I've got the 40% tax and then I've got my national insurance contribution. So by the time that money left my employer and landed in my bank account, 50% of it disappeared. Yes. Through tax and national insurance. And that's when I got a little bit sensible about my pension. So like, well, if I don't have that arrive in my bank account and I send it into my pension instead, then I don't have to share that 50%. And I get to keep all of the £5,000.
Yes. It's a great thing to have, isn't it? It's a great tool that we can use rather than eroding that bonus, which you've probably long looked forward to the whole year.
Well, yeah, I would be sensible with some of them, but not all of them. But I think it's maybe as I got a little bit older. But and I think this is just Catherine still furiously typing away there. It's just if you are a higher rate taxpayer and like, I'm just going to throw this in, if you've been offered a pay rise or if you're looking at other jobs, you're earning bonuses, just a quick calculation in your head is to figure out what that actually means to you. It's just half it. And that's what you're really getting.
I'll put my abacus down then, shall I?
What have you got for us, Catherine, then?
I based it on, to be a high rate taxpayer, you had to be earning over 50 something. It's early on a Saturday for me. So I thought, well, 60 is a doable number. So if I'm earning £60,000 and just based on me making the minimum contributions, which is 5%, that's £3,000 a year. But it's only costing, I lost track here, 1,800 is what I'm going to get back of that. So of that 3,000, take away 1,800. Michelle, it's too early for me. Is 1,200? I just cannot do this, Julie. Do not. I should have just kept quiet and just quietly played with my calculator. But it's nearly half, which is what Julie said a few moments ago. But if there's an additional 20%, so let's say that's £900, claim back for 4 years, that's £3,600 that could be sat there that someone hasn't claimed, that they could then put in their bank account. So it just sounds more like worth the effort than if it's just for £60, that's what I'm trying to say. So get a sense for, if you're putting a minimum in of 5%, what you could be claiming back. And we can always edit that out when I've had my second coffee and checked my figures.
Can I throw a little bit of a curveball into this then?
Hang on, we need to pause. Catherine?
No. I'm nodding for Michelle's curveball.
All right, okay.
So,
love a curveball, let's have it.
So we also have the other word which is banded about, which is salary sacrifice.
Oh. Notice
So
that Julie and I deliberately forgot that.
Well, it's one that they're all sort of, we hear these terms, don't we? And we sort of go, okay. And then I've had clients who come to me and go, you've just looked at me and said, okay, but I have no idea what it actually means. So the salary sacrifice allows you to exchange part of your salary for a non-cash benefit. So it won't just be pensions. You can have childcare and other bits and pieces through this, but we're talking about pensions today. But what it means is you need to agree for your salary to be reduced. So you'd have to sign, and this is the important bit, you would have signed a salary sacrifice contract. So say you earn £20,000 a year and you agree to sacrifice £1,000 of your salary, your salary on paper to people for mortgages, for lending, for anything else would only be 19,000. But what it does is the salary that you give up, so say £1,000 extra to go into your pension, you're not paying income tax on that amount and you're not paying national insurance. Mm-hmm. So it bumps up your contribution into your pension, and employers also won't need to pay national insurance on the amount of that salary you've given up. And some of them are nice and pass that on to you in the form of even more money into your pension, and some won't. So there's no sort of rule as to they have to, but it is there, and it can boost it up a bit more. And that gives you, for an employer at the moment, you know, that's an extra sort of 13.8% that goes into your pension. So this is a little bit more technical than the relief and source and the net pay, but it is a nice tool. And there are employers out there who use this a lot to boost benefits to employees. All right. Did I explain that okay?
You did. I'm grateful to you for picking it up, because on the surface, the sacrifice some of my salary and sign something to say I'm taking a lower salary, like that doesn't sound like a good idea. But then what you've explained to me is that it is, because the money's going straight into the pension. So I'm saving money on income tax. I'm saving money on national insurance. Employers like it because they're not having to pay national insurance either. And some of them are nice enough that that national insurance saving that they've made, they will throw into your pension. Not all of them, though. They don't have to. It's discretionary. Is that right, Michelle?
Yes. Yeah. And I think that would be it. And that's the extra benefit, is that the national insurance side of it is the extra benefit.
So even more free money into your pension if you go with a salary sacrifice scheme.
Yes. Okay. I think we've just got to be really mindful that I have had clients who've said, I want to do this, and they've done it, but when they've then come to remortgage and you need that salary in order to guarantee the amount you need for your mortgage, it has come back to sort of bite them a bit. So you need to be quite mindful of how much you're reducing your salary by.
Okay, so I'm going to throw a question into the mix now. All right, so our listeners are sitting there going, well, okay, I get this sounds good. I'm going to chuck a load of money in my pension. The next question is how much tax relief can you get? Is there a limit?
There are limits. And it's really about a combination of what your tax band is and an annual allowance. So we are allowed to put into our pensions each year a maximum of 100% of our earnings up to £40,000. So whichever relief you are on, that's going to be the cap of how much you can have back from HMRC. So Michelle can work that out for us quietly in the background. There is an additional cap for a lifetime on pensions, which Michelle also has spent all week doing, but it's in excess of £1 million, and it goes up in sort of funny numbers on the end. So it's 1 million with a few funny numbers on the end, but not very many funny numbers on the end.
Yeah, the 1,073,100.
There we go, 73,100, really memorable little set of numbers on the end there, which if you're very close is going to be very valuable to you, but obviously mine isn't. So so that would be the caps there based on the annual allowance and your actual tax rate. And then, like Michelle covered off right at the very beginning, if you've got no relevant earnings, you're capped to that 3,600.
All right, awesome. So 100% of whatever my earnings are, or £40,000.
Yeah, up to £40,000
a year
per year. So if you are earning £40,000, you could put the whole of your salary into your pension. I don't know where you would, but if you're earning 60, you're still capped at 40. And that's important for, I think, what you are going to explain to us shortly, which is in and around limited companies.
Am I? Okay.
Yes. I don't know when you're doing that, but that's definitely a key for.
Shall I do it now then?
Go for it.
It seems a natural point of the conversation. So if you've been listening to this and you're like, okay, you've explained all the different people and how it works for them, but you keep talking about employees and I'm not an employee. Well, I am an employee, but I'm the sole director of a limited company.
Yeah.
And I know that we've got lots of business women that listen to this that are in that situation. So thankfully, we've got Michelle here to keep me right. Okay. So the way it works is, rather than you as an employee making that pension contribution, because quite often that's not the best way for limited company directors to do it. Because typically what you will do is you'll probably be taking a lower salary and taking dividends. And going back to that cap that Catherine was talking about, how much you can put in, it's the salary that counts. The dividends don't count. So if you're taking a normal director salary of between, say, 8 and 12, depending on how you've worked out, £8,000 or £12,000 a year, that's how much you could put in the pension. Your dividends don't count. So it actually makes sense for the company to make pension contribution for you. And it is actually the most efficient way to extract profit from your business as well. So the way it will work is, at the end of the year, you will look at how much money the business make, and then you will start to make all the allowable deductions that you can. The pension contribution is an allowable deduction. And as you know, once you've got rid of all your allowable deductions, and that profit figure that's left, that's the bit that gets taxed by corporation tax. So picking the money up from the company and putting it into the pension means that you don't have to pay corporation tax on that amount. And it's now safely stowed away inside the pension. So you haven't had to pay any national insurance on it. The company hasn't had to pay any corporation tax on it. You haven't had to pay any income tax on it. The money's just been moved from the company to the pension. And you've not been limited by the fact that you take a lower salary because you're the director.
Yeah.
Did I miss anything?
No, but just to clarify exactly what you said, that if you're taking a salary in and around 8 to 12,000, for example, that would be what you're limited to. But by doing it the way you've just suggested, it means that they can go right up to the annual allowance, which we said was 40,000, and carry it back to any previous years if it's something they've not already done. So it just means you've got a much bigger amount that you are able to put into your pension before your own company year ends, not only for the corporation tax, but for your long-term savings and your future pension.
Yeah, and I think, so I was talking about single company directors. So it's dead easy for them to do. If there's more people in the company, there's a few more rules that you might need to check. The revenue are generally fine with it, but it's just it's to do with the wholly and exclusively rules. But generally, it's okay. And I think in a couple of years' time, corporation tax rates going up. So right now, it's a saving of 19%. For some businesses, in a few years' time, that's going to be a 25% saving. So definitely an option.
Yeah. And I think I would say, perhaps in that scenario, have a conversation with your accountant and your financial advisor, just to make sure you're getting the right amounts in. And especially if it's more than you.
Yeah, that is actually a really good idea, getting your advisor and your accountant together, because it's in looking at the cash flow forecast of the business and knowing if your profit's going to hit that £50,000 mark. That's the kind of the tip over point where corporation tax rates are going to go up for you. So now is a good time to be doing planning for that.
Yeah.
Oh, yeah. Great point, Catherine.
You're welcome. I think if us professionals work together, you put an accountant and a financial advisor together advocating for you, you've got the best of both worlds.
See, on the surface, putting a financial advisor and an accountant together does not sound like fun, does it?
I've had some really great relationships with accountants, but that's probably a different podcast. No, I'm teasing. In terms of clients, because they're like, here's the business, here's the profit, and they're doing it from their perspective, and there's me from the client's perspective, and put the two together, and plus you've got compliance tick box as well. So yeah, good relationship.
Rock and roll. Okay, now something's just occurred to me. So we've done all the employees and we've done the limited company directors. What about people that are self-employed?
To my mind, Michelle can pick me up if I'm wrong, I treat the self-employed like we've talked about with the employee contributions, except that there's no employer contribution alongside it. So I would make a personal contribution into my pension, and as a basic rate taxpayer, get 20%. As a higher rate taxpayer, I would be doing my self-assessment anyway because I'm self-employed, so I would factor that in to claim that back. And if I was a nil rate taxpayer, then I would still get the basic rate taxpayer. So it's like the employee, but without getting an extra top up from your boss, the employer contribution.
All right, so if I'm self-employed, then it's working exactly the same way for me as it is for employees. I put my £80 in the pension and the revenue throw in another £20.
Yeah, yes. I don't know, I needed to think, but yeah, exactly that. So, and if you are self-employed and you think you can't have a pension because it's just you, yeah, then you can just go and find any provider of a personal pension, or again, speak to an advisor. But if you want to do it yourself, I'd just find a personal pension, take the money as you would from your company as though you're your employee, and then make your pension contribution for your tax relief, and use the self-assessment if you are taking a higher income from that. So it's really, really straightforward. Loads of providers out there. A pension, whichever provider does the same job. A pension is a pension, a personal pension anyway. Just watch out maybe for some of the costs and charges associated with actually having access to that pension. But otherwise, it doesn't matter what the colour of the logo is, the pension operates in exactly the same way.
All right. Well, that's been a whistle-stop tour of pension tax relief. What the actual... So is there anything else that we wanted to add?
I think from the listener's point of view, we've covered most scenarios, all of the different tax rates and all of the different types of employment. And those, to me, are the bits that make a difference between how your tax relief is applied and how much it is. And plus, I did have to do an on-the-wing calculation in there just of my own doing, which I'm still not entirely convinced about. So I'm done. That's definitely time to budge up on the sofa for another coffee for me.
All right, thank you for that, Catherine. Michelle, is there anything else you would like to say to the listeners before we wrap up this episode?
No, I think as Catherine said, we've covered pretty much all bases on it. The only other thing I would say is that you can only get tax relief up to the age of 75. So I have had clients who thought they could carry on after that. And then I've had to sadly break the news to them that they won't get tax relief after the age of 75. So that's the only other thing I would add in, but I think we've done quite a good whistle-stop tour.
All right, that's fantastic. Thank you very much, ladies. So I think the key takeaway there is it's all magic money is getting thrown into your pension. There may be extra magic money out there for you if you're a higher rate taxpayer. In the show notes, we will be sure to leave that template that you can go and use and send off to your provider, the revenue, and they will send the money back to you. We would love to hear any stories that you've got about pensions and about how this episode might have changed how you think and feel about them. So drop us a message. We love hearing from you. But until next time, thank you.